participants. So good morning, everyone, and welcome to ASB webinar introducing ED 302 disclosures in special purpose financial statements of certain for-profit private sector entities. My name is Helena Simkova, and I am joined by my ASB colleagues Kim Carney and Tom Lyasis, who will take you through the presentation. We also have Anne Waters from AUASB joining us, and she will talk a bit about audit impacts. Before we start, some housekeeping rules. So the webinar is being recorded, and the recording will be published on ASB websites later. As with all the presentation, our views expressed at these webinars are ASB staff views, and they don't need to be necessarily shared by the ASB board members. We will start with the presentation with the overview of the exposure draft, which was published this year. We will provide some information about proposed disclosure requirements, why the amendments are being proposed, who will be affected, and also the proposed timeline. We will walk you through some illustrative examples as well. You can ask questions anytime during the webinar using the Q&A function, and we will pause and try to answer as many of them as we can. When we are answering your question, we can unmute you, so that will enable hopefully better discussion, so you can clarify the questions or tell us whether we actually answered your questions or whether you need any more details. Now, before we start, we will start with a quick polling questions. So, Tom, over to you.
Sure, thanks, Helena. So the first polling question for today is just to seek what your role is in relation to financial statements. So if you could choose one of the answers below, please. So we might just give it 15 or 20 more seconds. It seems we've got 70% have voted. Okay, so not an overmix, but it seems we've got 5% preparers, 64% from professional services, 40% professional bodies. Unfortunately, we don't have any users, and about 18% others. So a bit of a mix, but yeah. Anyway, I'll pass it on to Kim. So did you want to take us through what the proposed disclosures will look like?
Sure, thanks, Tom. So this slide outlines what the proposed disclosure requirements are. So for example, entities will be required to disclose the basis on which the decision to prepare special purpose financial statements was made. So that's why management consider it's appropriate for entities to prepare special purpose. Now, the board noted that APES 205, which is expected to apply to a number of in-scope entities, and we'll come back to in-scope entities shortly. But the board noted that while APES 205 is expected to apply, and it presently contains a requirement for entities to identify the purpose for which the special purpose financial statements have been prepared, it was felt by the board that it was important to have this information, or this requirement rather, mandated in an Australian accounting standard, and it will help ensure that users are provided with useful information, so they're actually understanding, you know, why management think it's okay or appropriate to be preparing special purpose financial statements. Entities will also be required to disclose a summary of their material accounting policies, and as I said, we'll cover the scope shortly. But the proposed requirement to disclose a summary of material accounting policies is really important. A significant number of the entities in scope currently have no accounting standard requirement to disclose their significant accounting policies. So again, while a lot of them may well be within the scope of APES 205, which requires the disclosure of significant accounting policies, the way accounting standards are drafted presently means that the majority of in-scope entities are not required to disclose this information. And the board felt that proposed amendment to require that disclosure was really important, because without information about the accounting policies, information about the extent of compliance or otherwise with recognition and measurement requirements, for example, could be incomplete, and it could be quite unhelpful because you don't have that context. The next disclosure requirement relates to entities that have subsidiaries, investments in associates, or investments in joint ventures, and they need to disclose whether or not they've been consolidated or equity accounted. So currently, even if an entity's special purpose financial statements claim compliance with Australian accounting standards, the entity is not required to assess whether or not they control subsidiaries, for example, and consolidate them where they are that non-reporting entity. So for this reason, it was felt that the requirement to disclose how they haven't accounted for subsidiaries, associates and joint ventures will greatly enhance the transparency of financial statements. Now, the entity also needs to disclose whether or not the material accounting policies applied in the special purpose financial statements comply with the recognition and measurement requirements. If they do, they disclose that fact. If they don't, they also need to disclose an indication of how they don't comply. So, for example, the entity may not have provided for employee benefits or something like that. The board made it clear that when disclosing an entity's accounting policies and disclosing, for example, that they do not comply with recognition and measurement requirements, the board's not proposing and certainly is not expecting a quantification or a reconciliation of the extent of non-compliance. They're just asking for or proposing a factual statement that says we don't comply, and this is an indication of where we don't comply. Now, this disclosure is particularly important because it's not always clear to the users of financial statements, particularly special purpose ones, which accounting policies do and which accounting policies do not comply. So for this reason, this requirement also enhances the transparency of the financial statements, and it also allows them to be more easily compared to other special purpose financial statements and also general purpose financial statements, because there's that increased transparency about exactly where they sit, and that's helpful. That information is helpful to users. The last disclosure requirement is where an entity discloses whether or not the special purpose financial statements overall comply with the recognition and measurement requirements. So obviously, if all accounting policies, all material accounting policies comply with the recognition and measurement requirements, then the financial statements overall would also comply. If you've got one or more instances of a material accounting policy that doesn't comply with the recognition and measurement requirements, then obviously the financial statements overall would not comply. I'll just pause here. We haven't got any questions coming through, but as Helena mentioned at the beginning, if you've got any questions about anything as we're moving through the presentation, please feel free to type them into the Q&A function. And we can address them as we move through.
Kim, maybe I will just start with one of the questions that we actually heard already before the webinar from the participant. And the question was, why is disclosure on consolidation and equity method required? Because I think that some of the stakeholders did not really understand why they need to disclose this. So would you be able to take us through the details?
Yeah, sure. So I think this disclosure is particularly important because it's not always clear whether or not entities have consolidated their subsidiaries or equity accounted for their associates or joint ventures. And it's also not clear whether entities have consolidated all of their subsidiaries, some of their subsidiaries, whether they don't have any, and things like that. So this contextual information, if you like, is very important to sort of set the scene. And that provides users with an understanding of, is it a single entity? Is it a group? have they got subsidiaries, what have they, or how have they accounted for them, and it puts the the users rather, on notice that they can ask further questions of the entity if they need more information.
Thank you, Kim. We also heard other people asking about the trans-Tasman convergence. So how is the trans-Tasman convergence affected? Would you be able to answer this question?
Sure. So for those that are familiar, we have the AASB for-profit entity standard setting framework, and that framework requires, wherever possible, that differences between accounting standards issued in Australia and New Zealand should be minimised, and this is to sort of reduce costs for entities operating trans-Tasman. Now, in New Zealand, they've got the New Zealand equivalent of AASB 1054, and that standard won't be amended in a similar fashion if these proposals proceed. And the reason for that is that in New Zealand, entities that apply accounting standards issued by their standard setter have an obligation, a statutory obligation, typically, or they're choosing to prepare general purpose financial statements. So in New Zealand, entities can't prepare special purpose financial statements where they have that statutory obligation. So therefore this this information isn't as relevant to them.
Thank you, Kim. We don't have any any questions at this moment, so I think you can continue with the presentation.
Sure. Okay, so we've covered what's proposed, and so I thought we'd just spend a little minute now going through why the proposals are needed. So as you may be aware, the AASB has limited the use of special purpose financial statements in the for-profit private sector from 1 July 2021. So from that date, only certain entities may continue to prepare special purpose financial statements. Now, those permitted entities, so to speak, are those that have a non-legislative requirement to prepare financial statements that comply with Australian accounting standards, where the document was created or last amended before 1 July 2021. So that's a bit of a mouthful, but that includes entities like your trusts that are required by their trust deed, partnerships required by partnership agreements, joint ventures required by joint venture agreements, self-managed super funds, entities required by financing or lending agreements and things like that. So because of the way that those requirements work, it means that there's likely to be a significant number of entities that will be able to continue to prepare special purpose financial statements, and they'll be continuing to prepare special purpose financial statements potentially for quite some time due to the way, as I said, the exemption works. Now, as these permitted entities have a requirement to comply with Australian accounting standards, their special purpose financial statements will state this. And this was something that the board was concerned about because research and anecdotal evidence indicates that special purpose financial statements that state compliance with Australian accounting standards may or may not comply with recognition and measurement requirements. But in any case, it's often not clear to users whether or not they comply. And this lack of transparency and clarity is confusing, particularly because we understand that users aren't always clear that special purpose financial statements in Australia actually don't need to comply with recognition and measurement requirements because directors or those charged with governance have the ability to self-select their own accounting policies. So the disclosures proposed in the exposure draft will enable users to clearly understand the basis of preparation and the extent of compliance or otherwise with the recognition and measurement requirements in Australian accounting standards. So one thing I just wanted to point out is that while these proposals prescribe minimum disclosure requirements, they do not prescribe any recognition and measurement requirements. So the exposure draft is not expecting entities to change their accounting policies unless they choose to, obviously. Entities are just expected to clearly disclose what they're doing and whether or not it complies with the recognition and measurement requirements in Australian accounting standards. So who will be affected? The proposals in the exposure draft apply only to for-profit private sector entities. So we'll talk about not-for-profit entities shortly, but these proposals apply only to for-profit private sector entities. And as I mentioned earlier, It's those entities required by legislation to prepare financial statements that comply with Australian accounting standards or accounting standards, or by their constitution document or another document to comply with Australian accounting standards. So those entities are still permitted to prepare special purpose financial statements, and that may be for the foreseeable future, or it may be short term. Okay. So mentioned previously, trusts, partnerships, joint ventures, self-managed super funds, and this is only where their constituting or other document was created or last amended before 1 July 2021. Now, the date of 1 July 2021 is very important, because if the constituting or other document is created or amended for any reason on or after this date, then the entity won't be able to prepare special purpose financial statements anymore, where the document requires compliance with Australian accounting standards, and instead they would be required to prepare general purpose. So if a document is created or amended after 1 July 2021, it's really important to consider what information the users of the financial statements require, because after this date, including a reference to compliance with Australian accounting standards will cause the entity to be required to prepare general purpose. At this point, I will just note that AASB staff have prepared a key facts document, which is more related to the requirements in AASB 2020-2, which is the amending standard which removes special purpose financial statements for certain for-profit private sector entities. However, that key facts document is quite helpful, because it's written for preparers of constituting documents, lending agreements and things like that. And it's got some helpful information about the different terminologies and phrases that can be used, and what the effect of those may have on financial reporting requirements. Now, if we look at the entities listed in the second point, so these entities, as I mentioned earlier, will only be able to prepare special purpose financial statements for one last reporting period before they will be required to transition to general purpose financial statements. So this is your entities such as your large proprietary companies, your unlisted publics other than your small companies limited by guarantee, small foreign controlled proprietary companies, financial services licensees, small proprietaries with crowdsource funding and the like. So we've talked about which entities are in scope, and I thought we'd now just spend a minute talking about which entities are not in scope. So those entities that are outside the scope will be any for-profit entity that is not required by something to prepare financial statements that comply with Australian accounting standards. So there might be a whole host of entities that still have a requirement to prepare financial statements, but instead of being required to comply with Australian accounting standards, they might be required to comply instead with generally accepted accounting principles, or they might be required to prepare financial statements that give a true and fair view, or the financial or the basis of preparation may simply be silent. So they're still preparing financial statements, but they don't have that hook. They don't have that requirement to comply with Australian accounting standards. So your for-profit entities in the public sector are also out of scope. And as I mentioned, not-for-profit entities are also out of scope. Now, just quickly on the point of not-for-profit entities, for those of you that have been following the work of the AASB closely, you may recall proposals similar to what we've been talking about this morning that were previously exposed mid-last year. And the outcome of those proposals was that not-for-profit entities have similar disclosure requirements to those proposed in this ED, and they're included in Amending Standard 2019-4. So if you are a not-for-profit entity, you are outside the scope of this exposure draft, but there are other requirements that may apply to you. So now, Tom, we've got another polling question, this time about scope. Would you take us through it, please?
Yeah, sure. So are we, sorry, Kim, is the next question whether you agree with the proposed disclosures?
Sorry, yes.
Yes.
Sorry, I'm one polling question ahead. Thanks, Tom.
So I might just give it another 15, 20 seconds. It seems we've got 75% have voted. Cool. So it looks like there's a bit of a spread. So it's good to see that only 9% have disagree. We've got 48% agree and 43% unsure. So for those that disagree or unsure, I would encourage you to make a submission onto the ED. And I believe the deadline for that is the 11th of September. Is that right?
That's right, yeah.
Cool. And so this next polling question here is whether you agree with the scope of the proposals. So that is, do you agree with the proposed new disclosures should apply to those entities preparing special purpose financial statements that are for-profit private sector entities that are required by legislation to prepare financial statements that comply with either Australian accounting standards or accounting standards, and other for-profit entities that are required by their constituting document or another document that prepare financial statements that comply with Australian accounting standards. We've currently got about 73% of participants voting. So at the moment, 65% have said they agree with the scope, 22% disagree, and 13% are unsure. So a bit of a mix, which is good. So again, if you disagree with the scope, we do encourage you to please make a submission onto the ED. So Kim, did you want to take us through the proposed effective date?
Sure. Thanks, Tom. Okay, so as the proposed amendments are quite narrow in scope, at this stage, the expectation is that a final standard will be issued prior to 31 December 2020, with a proposed effective date of annual periods ending on or after 30 June 2021. So that's your 30 June 2021 year ends and beyond. Now, I've talked a little bit about this, but the effective date is really important because it's referring to years ending on or after 30 June 2021. So it means that there are some entities that won't be permitted to prepare special purpose financial statements from 1 July 2021, such as your large proprietary companies. And so they would be required to make these disclosures for one reporting period. Now again, as the disclosures are factual, they're not expected to be too burdensome, particularly as those entities that will be required to transition to GPFS should already be well advanced with their transition and should therefore be aware of which policies do and do not comply with the recognition and measurement requirements. And for the other entities in scope, the expectation is that they'll have relatively unsophisticated or uncomplex, probably not the right way to say it, but their transactions won't be particularly complex. So again, expecting whether or not they comply to be a reasonably straightforward process. So one other thing to mention is that while large proprietary companies may choose to prepare special purpose financial statements at 30 June 2021 and include these proposed disclosures, given the increased need for transparency in the current economic environment, preparers should really be reconsidering or considering this decision very carefully, particularly in light of the comments from Treasury and others around the economic significance of large proprietary companies and the need for information from users and things like that. Now, before I pause for any questions, we have another polling question. So this time it's asking whether you agree with the proposed effective date. So if I could just get you to select your answer, please. Okay. Just end the poll question and share the results. So interesting, views are quite mixed about whether or not you agree with the proposed effective date. 50-50 with a small portion or a smaller portion unsure. So again, as Tom has mentioned, if you have any feedback, we would be really pleased to receive that. This particular issue will be going back to our board at the November board meeting, and comments on the exposure draft are still open, but we'll come back to ways that you can engage with us shortly. So Tom, could you take us through some of the illustrative examples in the exposure draft now, please?
Yeah, sure. So ED 302 includes implementation guidance and illustrative examples, which are proposed to accompany the proposed amendments. And while they illustrate aspects of AASB 1054, they're not intended to provide interpretive guidance. So this slide summarises examples that are included in the ED. They're intended to illustrate the most common examples of non-compliance and also what the required disclosures may look like in various scenarios, such as when an entity may or may not comply with the recognition and measurement requirements in Australian accounting standards and may or may not consolidate or equity account. So we'll briefly go through 3 of the 4 examples that are in the ED now. So example 1, so XYZ Proprietary Limited is a for-profit parent entity that has prepared special purpose financial statements at 30 June 21. At 30 June 21, it is not required to prepare general purpose financial statements. However, these will be the last special purpose financial statements that it can prepare. So XYZ special purpose financial statements consolidate all its subsidiaries in a manner consistent with the requirements set out in AASB 10. They equity account all its investments and in associates and joint ventures in a manner consistent with those set out in AASB 128. And they apply accounting policies that comply with all the recognition and measurement requirements in Australian accounting standards. So therefore, XYZ's special purpose financial statements state that they comply with all the recognition and measurement requirements in Australian accounting standards and that they have consolidated and equity accounted all subsidiaries, associates and joint ventures. So moving on to example 2. So M&O Proprietary Limited is a small for-profit proprietary company which prepares separate special purpose financial statements in order to meet the requirements of its financing agreement. M&O prepared separate special purpose financial statements and they have not consolidated its subsidiaries because the directors decided not to comply with AASB 10. Although the material accounting policies applied in the special purpose financial statements state that they comply with all the recognition and measurement requirements in Australian accounting standards. And therefore, M&O's special purpose financial statements state that they comply with all the recognition and measurement requirements in Australian accounting standards and that they have consolidated and equity accounted all subsidiaries, associates and joint ventures. So moving on to the 3rd and final example that we're going to go through. So ABC Trading Trust is a for-profit entity that has determined it doesn't have any subsidiaries, associates or joint ventures, and therefore AASB 10 and 128 are not applicable. ABC Trading Trust is preparing special purpose financial statements, and there are some material accounting policies that do not comply with the recognition and measurement requirements in Australian accounting standards. So for example, the entity has depreciated its property, plant, equipment using tax rates rather than accounting rates. And so for this reason, ABC's special purpose financial statements state that they do not comply with all the recognition and measurement requirements, and they explain where the differences are. So now that we've looked at some of the examples that are in the ED, Kim, did you want to take us through some of the additional examples of potential areas of non-compliance?
Sure, thanks, Tom. So the last illustrative example that Tom took us through highlighted one of the more common instances of non-compliance. So that's the depreciation of property, plant and equipment using tax rates. So this slide lists some of the others that staff are aware of from our discussions with those in practice. So along with depreciating property, plant and equipment at tax rates, some entities may not depreciate their property, plant and equipment at all. Some entities may also not apply tax effect accounting. Some may have adopted cash accounting rather than accrual accounting. So they might not be recognising debtors and creditors, for example. and they may be accounting for revenue and expenses on a cash basis as well. So some entities may also not be providing for employee entitlements, or may be providing, for example, for annual leave, but not long service leave, and anything in between. There might also be some entities that aren't accounting for leased assets on the balance sheet, so therefore they're not in compliance with AASB 16. And I mentioned earlier, but as staff, we acknowledge that you know, in some cases it should be relatively straightforward to identify instances of non-compliance, you know, for example, where tax balances are not recognised. But in other cases, it might be more challenging. However, the expectation is that, you know, a significant number of the entities that would be affected by these proposals will have, you know, fairly straightforward accounting transactions, and therefore, you know, the identification of non-compliance should be relatively straightforward. Some areas where it might become more challenging, you know, entities selling goods or providing services, for example, might not know whether or not their revenue recognition policy complies with AASB 15. And we understand that going through that process, you know, might be time consuming and it might be costly, but the difficulty or how challenging determining non-compliance or compliance may be will depend on the nature of the services provided, you know, if you're selling goods, whether they come with warranties and any and all of those sort of variations and permutations. So staff are particularly interested in feedback on this point, and whether stakeholders agree that it might be challenging for entities to know whether or not they comply with recognition and measurement requirements, or whether you know, stakeholders agree that for entities with less complex accounting transactions, it should be fairly straightforward. So I'll just pause here. I can see we've got some questions coming through. So there's a question here from Kerry. Kerry.
Tom, could you please unmute Kerry? So Kerry is asking, why is there no opportunity to say not yet assessed, like there is for not-for-profit entities?
Thanks, Kerry. This is something that the board considered really carefully when they were formulating the proposals in this ED. So the board acknowledged that those for-profit entities with a non-legislative requirement to prepare financial statements, so your trusts, your partnerships, your joint ventures, things like that, the board acknowledged that they may benefit from being able to disclose that they have not assessed compliance with certain accounting standard requirements, and that it might minimise burden while still highlighting potential instances of non-compliance to users of the financial statements. However, you know, after careful consideration, the board took the view that for-profit entities would typically be expected to have access to resources or to the resources necessary to make the required assessments, and therefore should have an understanding of the recognition and measurement requirements, and it forms part of good governance. The board considered, you know, as we talked about, that while many of the entities may be small in size, their accounting transactions, you know, are not expected to be overly complex, and therefore the assessment itself would not be complex. But it was certainly something that the board, you know, considered carefully and spent quite a bit of time thinking about. But the reasons why the for-profit entities don't have that option is really coming down to being for-profit and having the expectation that they would have access to greater resources than their not-for-profit counterparts. Does that help, Kerry? Okay.
Here, do not hear anyone talking. So Kim, maybe I would share another question that we have heard previously. So people are asking whether the proposals are retrospective, retroactive.
Yeah, sure.
So could you clarify?
Yeah, of course. Thanks, Helena. So the answer is no. While early adoption is or would be permitted and would indeed be encouraged, the proposals are expected to be issued as a standard in December 2020, and they would be effective for annual periods commencing on or after 30 June 2021. So because the standard would be issued before the annual period, before the end of the annual period to which the expected standard would be applied, they're not considered, it's not considered retroactive. And so that's why I was very careful to point out that it's annual reporting periods ending on or after, because most accounting standards are annual periods beginning on or after. So that distinction is quite important, particularly in cases like these.
Thank you, Kim. I would also encourage all the participants who actually were unsure or disagreed with some of the proposals or with the scope to share their concerns using the Q&A boxes, because that would give us opportunity to discuss in details. Another question that we have heard before was whether actually AASB quantified how many entities would be affected.
Yeah, sure. So the answer is not entirely. We understand that there's around about 600,000 self-managed super funds that may be affected. And we understand that there's around 360,000 other trusts that are reporting total business income with the ATO. There's a whole host of other entities that may be affected, you know, your partnerships, lending agreements, things like that, and we haven't been able to quantify those, but we've got some information about some entities or some of the entities that may be affected, but not a complete picture, no.
Thank you, Kim. We do not have any more questions at this point, so we can continue.
So Tom, it's time for another polling question. Could you take us through that, please?
Yeah, sure. Thanks, Kim. So I think this is the final polling question that we have for today. So now that we've gone through the proposed disclosures, who will be affected, the proposed effective date, and a few of the illustrative examples that are in the ED, we would like to understand whether you think the proposed disclosures will increase the transparency and comparability of special purpose financial statements. So we'll just give you half a minute to a minute to answer. So we've got about 64% voted at the moment. So I might just give that a bit more. Okay, so it's good to see that about 80% agree. We've got about 5% that disagree and 15% that are unsure. So again, like we've said a couple of times, we would urge you to submit any feedback on ED 302, and the closing date is the 11th of September. So now before we wrap up, I'd like to pass it over to Anne Waters from the AUASB to get her insights on the proposal.
Thanks, Tom, and thanks, Kim, for the presentation. So I suppose the audit implications. Look, at the end of the day, it's the preparer's responsibility to determine what financial reporting framework they're using in the preparation of the financial report, and to determine whether it's still appropriate to prepare special purpose financial reports, especially given the recent amendments that Kim's been through, the narrowing of entities that can prepare special purpose. So it's preparer's responsibility. It's also their responsibility if they are preparing special purpose financial reports and they're caught by this ED, depending on where the disclosures end up. It's their responsibility to make those disclosures and to make those assessments as whether the financial report has been prepared in accordance with the R&M requirements. Then the auditor's opinion is on the financial report as a whole. So it will include these disclosures if they are mandated. So the auditor's opinion includes whether the financial report as a whole is free from material misstatement, and that includes whether they agree that the additional disclosures that are required in relation to the accounting policies and in relation to whether they are in compliance with R&M, whether the auditor agrees that those disclosures are materially correct. Just want to remind auditors that ASA 210, ASA 700 and ASA 800 already have specific requirements that the auditor needs to consider and to comply with in relation to the acceptability of the financial reporting framework and the appropriateness of the disclosures about the significant accounting policies. So their existing requirements have always been there. The acceptability of the financial reporting framework, especially if it is a special purpose financial reporting framework, it's really important that auditors look at that closely, given the recent changes that Kim's been through about the narrowing of the ability to prepare special purpose financial reports. So if your client is preparing special purpose, make sure that they're within the requirements, the new requirements. So when they're assessing whether the financial report is free from material misstatement, if it's a special purpose financial report, they need to make sure that under 700, the financial report adequately refers and describes the special purpose reporting framework and the material accounting policies. Have the additional required disclosures been made in the financial report, and do they agree that they are materially correct or not materially misstated? So the auditors have to make that evaluation when they're forming their opinion on the financial report as a whole. So as Kim's been through, it really depends on the entity as to what the impact of these disclosures are and how difficult some of those assessments may be, especially as to whether they're in compliance with R&M. So, I just remind preparers and auditors to make sure you engage early on these discussions. The preparer needs to make sure that they've given adequate information and evidence to the auditor to enable them to form that opinion. So what have they considered? What has the preparer considered when they've made this assessment? That information needs to be provided to the auditor. Now, the AUASB did issue a bulletin last year, just reminding auditors their responsibilities in relation to the assessment of the acceptability of the financial reporting framework. That bulletin is a little bit out of date because it refers to the old ED, but the principles go through what I've just briefly described on this slide, what the requirements under 210, 700 and 800 are when when the entity is preparing a special purpose financial report. So we will update that depending on where this ED lands, but that information is still relevant and hopefully is helpful to auditors. So that's it.
Perfect. Thanks, Anne. Some really important reminders there, I think, for auditors and preparers alike. So before we wrap up and I call for any final questions, this slide just outlines a few of the ways to get in touch with us because, as always, we're very keen to hear from you and we greatly appreciate any and all feedback you may have. So we've mentioned a few times now, but comments on the ED close on the 11th of September. We are aware that it is a very busy time of year for a lot of you, and therefore you may not have time to provide formal submissions, but we're more than happy to receive feedback by email, either via the standard@asb.gov email address, or you're welcome to contact ASB staff directly. You can contact us via LinkedIn. We're happy to arrange a phone call to discuss any of the aspects of the proposals if you'd prefer. The key thing I wanted to highlight, I guess, is that feedback is welcomed, greatly appreciated, and we would encourage you to engage with us in whatever way is, I guess, most convenient for you. So we have some time for some more questions. Helena?
So I just saw a comment, one of the participants was asking whether the slides would be available. So yes, the slides and the recording of this webinar will be available later on ASB websites. Apart from that, Kim, I don't think we have any more questions.
Okay. We've been very efficient. We allowed an hour to run the webinar, and we have come in just under time. So if there are no final questions, we've reached the end of the material that we wanted to share with you today. I would like to thank each of you for your time and your participation. I will provide you with our contact details. So as mentioned, please reach out to any of us with any feedback that you may have. And any and all feedback will be taken to our board at their November board meeting when they consider these proposals again. So on that note, again, if there's no final questions, that's all that I had to say. Helena, I'm not sure if you had anything else to add before we close the webinar.
No, I would just I would like to thank you to all participants and encourage them again to submit any feedback. If they have any concerns, please share them with us. I would like to thank you, Kim and Tom and Anne, for the presentation. And I hope it was useful and it provided a good overview of the exposed draft. Thank you, everyone.
Thanks, everyone. I'll now end the webinar.
Thank you.